Hello, Neil Wilding here. I'm one of the partners of Stonewood Financial, and I want to welcome you to this webinar launching our new software marketing and training program we're calling Roth Done Right. As you can guess, we're diving into the world of Roth conversions, and we want to help you have meaningful meetings with your clients with calculations around taxes, around IRMAA, around what's the ideal conversion pattern for assets that you have earmarked for those Roth conversions. So as I said, we've got software to show you. We got some marketing materials that come with it and a training aspect that makes this one of the most unique programs in the industry. So let's dive right in. Um, so Roth Done Right. Really, what we want to do is help answer three questions for you and your clients. First, is a Roth conversion right? For me, meaning your client there. And we're going to give you some calculations around taxes and around IRMAA to help identify, just like a quick high-level glance at your tax situation and your IRMAA situation all around IRA assets and whether they make sense for conversion. Now, once we answer that question, a lot of times people say, well, that's the Roth conversions are easy. I can just do that in my Schwab account and do it on my own. You got to love the do-it-yourselfers. And so the second question that we want to help answer is really a rhetorical question, but it's, can I do this Roth conversion on my own? And again, that's from the client's perspective. And the answer to that is an overwhelming no. And what we're going to do with the software output and with the marketing and training that we provide you through this program is just we're going to give you data and show and expose variables that can come into play during a Roth conversion that the do-it-yourselfers are just not thinking of. And once we show that, then they're going to have no choice but to go through the conversion process with a trusted advisor. That is you. And so that's the second piece. And then the third piece is, okay, so, is a Roth conversion right for me? Yes. I need help. And then the final piece is, okay, how do I optimize this? I've got X amount of dollars that I have earmarked for conversion. Should we do it all at once? Should we spread it out a little bit? What is that optimal pattern? And we answer that question through the lens of what's your tax situation look like? What's your IRMAA situation look like? And then we put a bunch of variables in play or put them that are in play, we put them together to help calculate what that optimal pattern is. So hopefully you're excited to see what we have, because I'm certainly excited to bring this to you as part of this launch. So let's dive in. Ultimately, what we're trying to do here with this first piece of software is we're looking at the impact of IRA assets on your tax and IRMAA, or on your client's tax and IRMAA situation. So we're not trying to calculate all of the taxes that your client's going to pay and all of the IRMAA surcharges that they'll pay. No, what we're looking at is an IRA asset. Think of an IRA dollar. And once we assume that IRA dollar as income, what is that impact on my tax situation? And then the IRMAA surcharges that I may or may not be paying currently and then in retirement. And so that's the goal of the report. And so what we're going to do is, again, we're trying to help answer this question. Sure, my clients go through a Roth conversion, and we're doing this through the lens of taxes and IRMAA. And so in order to do that and make this comparison, what we have to decide is, okay, what are the calculations going to look like if we just stay in the IRA and compare that to what the calculations would be if we go through with a Roth conversion. Now, the challenge is when you think of IRA money, people access those in different ways. Some IRA money might be earmarked for the kids, their legacy assets. I don't really need them in retirement, so I'm just going to go through the required minimum distribution process, and then what's left over goes to the kids. Other people have, they need every dollar in their IRA, and they will be using that through like a levelized income plan in retirement. And so those two patterns could have very different calculations on both tax and IRMAA. So what we're going to do is calculate both. And so we have these assets that are in an IRA, and we're trying to determine, should I go through a Roth conversion, and what would my taxes be? What would the IRMAA surcharges look like if we just went through the required minimum distribution process? So again, that's going to be mostly assets earmarked for legacy or your income later assets where I don't need the money, but I'm going to take my RMDs because I have to. Once those RMDs kick in, so for some people, we're pushing them into a higher tax bracket at that point. Maybe we're starting to create some IRMAA surcharges at that point. And so we're going to calculate what the lifetime tax bill and IRMAA bill would be through required minimum distribution. But like I said, some people need that money as soon as they can. And that way, we're also going to calculate what a levelized systematic withdrawal plan from that IRA would be. And that way, you've just got both sets of data. Now, when you sit down with your client, you can decide, the client might not know. And so we'll have both levels of calculation, or you can just focus in on what's most relevant to your client. But the key is we got some calculations. What's my lifetime tax bill going to be on my IRA money? What's my lifetime IRMAA surcharge bill going to be, at least according to the projections, on my IRA money? And then compare that to what would the cost of a conversion be? What kind of conversion taxes will I have to pay? And then will my conversion trigger any IRMAA surcharges that I wouldn't normally pay? And we're going to add them all up and compare them. And that's going to give you an idea. Now, in order to make those calculations, certainly we need to know what tax bracket they're in right now. And so we're going to do our best to calculate that for you. And so that means we have an input process. Now, what you're looking at is a screenshot of the output that summarizes what the inputs are. But it's a very simple process. We just need to know, okay, what kind of IRA assets are we looking at? How much total IRA assets do you have? And then what portion of those assets are we considering here for this calculation? And so those would be the potential conversion assets. We call that the analysis amount. And then you tell us, okay, my plan is to convert these assets over X amount of years. And I want to start that either right away or at some point in the future. And then we need to know some information about their current income. How old are they? What's their current salary, or what kind of income are they generating from their business currently? When do they plan to retire? When do they plan to elect Social Security, Medicare? Those are all key components here to us calculating what is a current effective tax rate. And that's, of course, going to be used in the conversion part of this. And then we also ask, what kind of Social Security amounts are we going to have in the future? Do you have any non-qualified money that you'll be living off of in retirement? Do you maybe have a guaranteed income annuity that's, a certain taxation that comes with it? Is there a certain part of our money that's going to be taxed in addition to that IRA as it hits our income statements? So we ask all of those questions just to get a simple idea on what is the effective tax rate now, and then what would the effective tax rate be going forward. We calculate that. You also have to let us know what the state income tax might be. That's just an input, because I know all of the states can vary greatly. And then you have an opportunity to change taxes in the future if you like, and there's a button there to increase the IRMAA surcharges over time if you so choose. For this, I'm just going to assume it's flat for a nice, simple example. All right, so those are your inputs at a high level. And so now that we have the inputs, now let's go through the calculations. And as I mentioned, what we want to do is, on one hand, we want to calculate the total taxes, total IRMAA we pay if we just keep the IRA. On the other hand, we want to calculate what would the conversion taxes be, and would we trigger any IRMAA surcharges at that point. First, we're going to look at it through the level income process. So this would be for your clients that are actually going to use that IRA. The income starts at whenever you tell us to, and we just calculate what a systematic withdrawal would be over a defined period of time. In this situation, remember, we're just looking at $500,000 in this example. I think the client had like 1.5 million maybe. We're just looking at $500,000, so converting maybe a third of their IRA money. Total taxes just through the required minimum, or through the not required minimum distributions. This is going to be for someone who's taking level income. So when they take the distribution out, the total taxes over their lifetime would be $349,000. Now, this was, I believe, a single filer, so there's going to be some IRMAA based on his income, and that would be a lifetime collect, add it all up, $30,000 worth of surcharges that this client would have to pay, not in total. That's just because of the addition of the 500,000 of the IRA money to his income over his lifetime. And so the total retirement tax bill and IRMAA bill would be $380,000. Again, that's through level. Now, maybe they're going to say, you know what, I don't need this money. I don't want to pay tax. So I'll just defer that money as long as we can. Well, dirty little secret. Actually, when we do that, we actually pay more tax, right? Once the RMDs kick in this case, just through the RMDs, you pay $473,000 in taxes. Why? Well, I think we all know this, right? It's because we're growing those assets. All that growth is taxed, higher distributions, could be higher tax brackets, more impact. Total bill here, $473,000 just through the required minimum distributions. Oh, by the way, another 30 grand to IRMAA. We still have to, pay those surcharges. And then finally, your all-in bill would be over $500,000. Now, hopefully we're asking questions in the chat. I'm unable to see them right now, but what I will do is if you ask a question, I will be able to pull a report of the questions, and I'll send everyone a private email after this webinar, and we'll start a conversation based on whatever questions you have. So that's what what our taxes and IRMAA would look like if we just keep the IRA. Now, we don't have to just keep the IRA, right? We don't have to sit back. We can take action. We can go through a conversion process. And I think what I did for this one is like an 8-year conversion. So we're spreading it out a little bit so that we don't have too much tax drift during the conversion. And so in this example, you're looking at about $126,000 in total taxes. Good news is we have no impact to the IRMAA surcharges. That could be because the client hasn't reached Medicare age yet. Well, really, we do the 2-year look back, right? But we haven't reached the point where we have an impact, or maybe we're spreading it out enough to where the conversion amount doesn't trigger IRMAA. Whatever it may be, in this example is 0. Now, as you run this for your client in your specific situation, still might have some IRMAA that we have to deal with, but usually it's going to be a lower amount because we're getting that money out the door. All in 126. So just from take a pause here. A lot of people just want to say, okay, should I keep this IRA? Should I go through the conversion process? Maybe some people say, I don't want to pay the tax. Like, oh my gosh, Roth conversions trigger taxes for me. Well, that's an illusion, right? It's a myth because IRA money is going to be taxed at some point, and it's just a matter of when. And so if we do the conversion, we're out the door for 126. If we do through a level income process, it's 379. RMD's 500,000, right? So pretty clear picture for, I probably do need to be considering a Roth conversion. And so I showed that to you in PowerPoint to help unfold the story. But this is a report, this is software, and this is one page of the output that you can see here that highlights exactly what we just showed you. So this is going to be an important page that you'll be able to use in your client conversations. Now, here's where I think a great use case of the software is. I just ran a base case here that shows a pretty compelling case for conversion. But I'm going to go in and I'm going to make 2 changes to my assumptions. And I think this is how it can be really used, is going and create multiple scenarios for your clients, because that's assuming everything that I put on the page there. So I'm going to make 2 important changes to the assumptions. And so just those 2 changes alone, and I'll get to what those changes were, but I made 2 changes. This new scenario suddenly has increased my tax bill to to all-in tax bill on an RMD only situation to $760,000. And look at IRMAA. IRMAA jumped from $30,000 to $144,000. What could possibly be going on that would, exponentially increase the amount of IRMAA that I would have to pay? Well, let's look at the assumptions I changed. First, I modeled tax changes. To me, why would anyone be considering a Roth conversion? Well, they consider a Roth conversion because they believe taxes could be higher in the future than they are today. Now, that could be because of their individual situation. Maybe they're concerned about the widow's penalty or concerned about their tax bracket going up. But most people are concerned about taxes changing, not in their own situation, but globally, or at least nationwide, right? Through the legislation in Washington that's going on, many people believe the taxes are at a discount right now, and they could be much higher in the future than they are today, just based on our country's trends. And so if we believe that, like that's the main driver for considering a Roth conversion. If we believe it, well, then we need to bake that into the assumptions. So I assume some tax increases in the future. Two, remember IRMAA? And we talked about IRMAA. Well, the calculation that I initially showed you was based on assuming that the IRMAA surcharges stay flat forever. And when we talk about legislative risk, like IRMAA is a prime example for how Washington can change the rules, and those rule changes have a negative impact on our retirement assets because the way that IRMAA works, the law has already been passed to where they can and do increase your premiums and your surcharges every year. And historically, those increases have been between 4 and 8% since 2019. It's been north of 7% on average, the increase that they've made. Last year, they did you a favor. Last year, it was only 5.9. But still, if we're just running the report and assuming IRMAA stays flat, we're immediately wrong. Like already written into law are those increases, and it's usually between 4 and 8. So I modeled a 6% increase here, and that's how I got these massive changes. All right. So on one hand, the report on the left said, yeah, definitely need to go through a conversion. Oh, but man, when you model in the fact that taxes can change and that IRMAA is going to go up, wow, the report just really starts to scream like we need to convert these assets and convert them in some cases as fast as possible. And so that's why a great way I see using this report. Now, a lot of people live in the details, and you should, right? This data is meaningless without understanding all of the assumptions and also understanding how the calculations are made. So we've got tabular data based on all of the scenarios we talked about, the RMD only scenario, the level income scenario, and of course the conversion scenario. And in that tabular data, you can see, okay, what's my effective tax rate? How is it impacted by the conversion? How is it impacted by retiring? And so it looks at what the effective tax rate would be at that point, and you can see everything unfold in that tabular data. Okay, so now that question to address the do-it-yourselfers. I can't tell you how many times I hear it where people, financial advisors using the concept of understanding tax risk, legislative risk, and addressing that risk with our clients or prospects, really, I should say. And they say, well, Roth conversions, I can just do those on my own. I can just do that in my Schwab account, fill out a piece of paper, and we're good. And we absolutely, we know that that's not true, but sometimes we have we need some help communicating the value we can bring to the Roth conversion process. And so I'm here to give you some more data, some more ammunition. And so one of the variables that we have is tax drift. And I think most people understand tax drift. Tax drift is the additional tax you pay because we're in a higher bracket, right? So, and that's an important part of the equation, right? A lot of people try to avoid tax drift at all cost. And I would say we want to avoid tax drift at minimal cost. Sometimes it might be okay to assume some tax drift, but we certainly don't want to incur too much of it. And especially at like high levels. All right, so that's tax drift. But the challenge is most people stop the analysis there. It's like, okay, what's my tax bracket? And is this Roth conversion going to push me into a tax bracket, a new bracket? Maybe I shouldn't do it, or I should do less so that that doesn't happen. And that's okay, but it's an incomplete approach because there's some other factors in play. And one of them I like a term that we've kind of created here at Stonewood is conversion delta. Now, what's conversion delta? Conversion delta is felt when taxes change during your conversion pattern. So let's just say we're going to plan to convert these assets over 10 years, right? We're spreading my Roth conversion over 10 years. And then taxes come in and Congress meets and they say, you know what? We need to collect more revenue. We got problems. Taxes are higher now. And if that happens, then do you think our clients would have been better off if we converted those assets before that tax change happened? Like if we're saying that taxes are on sale, isn't it better to consume as many of those taxes as possible while they're on sale so that we don't have to pay the higher rate later? And so if we have a 10-year conversion pattern and taxes change halfway through the process, then the back end of that conversion, you're paying a little bit more than you paid in the front end. And we've got some software that calculates that. It puts a number to that term. And what it's going to do is motivate people to speed up that process a little bit. And hopefully what you see here is these first two terms, I haven't even put the third one on the screen yet, are in direct conflict with each other, right? Because if we're only concerned about tax drift and looking at my tax bracket and staying in my current tax bracket during the conversion, well, then we're going to slow down that conversion as much as possible. But if we're worrying about taxes changing in the middle of the process, we're going to speed that up. And that's where I think we're really looking to bring value to you as the trusted advisor in this process. And then the third piece is IRMAA. And man, that breaks the whole thing, right? Because if we're already on Medicare and we're paying some surcharges, then maybe we want to spread that out and minimize the additional surcharges we might pay. But if we're not on Medicare yet, maybe we speed it up and see if we can't wrap this up before IRMAA comes into the picture. Or maybe it's somewhere in between, right? So you can see we got these first two that are competing, and then the third one, who knows? It's all based on where your client is in their own situation. So the good news is all these variables, the Roth Done Right software puts numbers to all of them. And so we'll look at your potential conversion patterns. And so we're going to look at assuming we convert everything in year one, and we'll go all the way down to 10 years. And we stop the analysis there because we think that paints a full picture just with a 10-year analysis. But it'll say, okay, what would the tax drift be if we spread this out 10 years or 1 year or everywhere in between? And, as you probably would assume, the more you spread it out, the lower the tax drift impact is. But now we go conversion delta, right? And I think in this example, I assume tax is changing in the 7th year. Well, that means we have no conversion delta for 6 years, right? So if we're only worried about conversion delta, then we would do a 6-year or less conversion. But of course, we have to balance that with the tax drift, right? And then the final piece is IRMAA. And this all matters, how old your client is. Are they on Medicare? Are they going to elect Medicare at 65 as soon as they can? Or are they going to push it out a little bit? Whatever it may be, right? It certainly has an impact. And so you put all three of these variables together, and we've got the individual calculations for you. And this is one of the pages in the report. But then ultimately, we got to put it all together. And so now we're going to calculate, okay, what's the optimal conversion pattern based on all of these calculations? And you can see the numbers kind of vary, right? Early on, there's a lot of tax drift, so it's a pretty high lifetime tax bill if we convert it all in 1 year. So we want to avoid that. We might want to spread it out. And if you kind of look at the choices here, whether that might be a 5-year conversion, a 10-year conversion, the lowest one on the page is actually a 3-year conversion. Those are all based on assumptions. But you just have data here where you can sit down with your client and say, okay, when does it make sense for us to convert this? Do we want to go as fast as possible? Do we want to adhere to these numbers here as strict as possible? That means a 3-year conversion. Maybe do we spread it out a little bit more and keep the tax bill at like 220, something like that? Whatever it may be, right? And these numbers, there is no garden variety basic scenario. Every single one of these you run is going to look very different For some of your clients, you're going to want to do a 10-year conversion every time, all times. For other clients, it might make sense to be kind of like this one, where it makes sense to speed it up and assume some tax drift so we can wrap up the conversion before taxes go up, before IRMAA becomes an impact. But the key here is giving you data to sit down with your client and have a discussion. All right. So as I mentioned, these reports are a part of a complete package that you get with the Roth Done Right software. There's technically two reports. The first report is the Roth conversion analysis, which does that high level, what my taxes be if I stay in the IRA versus go to and do a Roth conversion. And then the supplemental report gets into those individual terms that I talked about. The tax drift and conversion delta. And it'll be up to you when you sit down and start to incorporate these into your practice, how you want to go about doing that. All right. So in addition to the software, we also have marketing. And so we've got a full seminar that comes to you with this. We call it Washington and Your Retirement. And what it does is it introduces this risk that we call legislative risk. And within legislative risk, it dives into the fact that taxes very likely to change in the future. We need to plan for it. And then also IRMAA. It introduces this concept of IRMAA, which is a phenomenal example of stealth taxes and a way where Congress is increasing revenue. And let's call it a tax, right? They call it a surcharge, but you call it a surcharge or fee, whatever it is. It comes out of your retirement assets. It's a tax, right? And so it brings that into your marketing. So whether you're doing seminars, webinars, there's full presentation you can use. Or we've got modules that you can use. So maybe you've got a seminar that you like, that you use. You've been doing 3 seminars a week for the last 10 years, and it's just you got your process down. But you're like, man, I wouldn't mind just a couple of slides in what I'm doing now. Well, part of the membership, you get the PowerPoint slides. And so we've broken them up into modules for you where you can just kind of slice it and dice it and put it into what you're already doing today. We also have marketing resources. I've authored a white paper on the Roth Done Right concept here. There's a client brochure. We have client videos that you can use in your social media or in your some people like to play the videos at their events. And then we also have videos just for you on training. We've got a video on helping define tax drift and conversion delta and IRMAA drift and all sorts of training videos on all of the topics that this program really hits on. Not to mention the one-on-one coaching that we'll do with all of our members. So before we wrap up, I think it's important to kind of see this play out in an example. And I'll try and do this quickly because I know I've gone on here a little bit, but hopefully you can feel my passion in my voice here. I'm just, this is a labor of love in bringing this software to you. So I've got a 65-year-old couple here. Let's say they've got a $1 million IRA and they plan to retire at 70. So that's in 6 years. They're going to elect Medicare as soon as they can, and they're going to project a 5% growth rate to the assets. They're small business owners. Notice I'm giving you a lot of detail here so you can kind of paint the picture of what their effective tax rate might be now, how conversion might impact them, right? So we're just going to say they got a $1 million IRA, and they just plan to live off that IRA and Social Security. And they're considering a 10-year conversion because they're worried about tax drift. We want to spread this out as much as possible. All right, so I run the numbers, and right off the bat, I'm like, yep, makes sense. If we just take that $1 million, and if we're just going to live off of it, $512,000 in total taxes. If we go through the Roth conversion, that's a 10-year conversion. It would be $302,000. Seems to me like that makes sense. But maybe I'm asking some questions about like time value of money. That seems like a lot of IRMAA to generate, some extra surcharges when I normally wouldn't have to pay them. Well, let's ask a few questions here, right? Let's look at the individual variables in play. And so I'm on a 10-year pattern here. So if I go 10 years, I have no tax drift whatsoever. I'm able to convert all of those assets at my existing tax bracket. But if I model taxes changing in the future, I have a significant amount of conversion delta. And then also I got some IRMAA that I'd have to pay. And so that's, those are variables that are part of it. Now, I mentioned this client was going to elect Medicare right away, and most people do. But I did talk to somebody in the industry, and I said, does anyone ever defer Medicare? Like, if is there ever a reason to turn it down? And the Part B and D is the relevant part of Medicare here, because that's what generates the surcharges through IRMAA. And they said, yeah, absolutely. If they've got a good plan where they can get access to it, and if they're due to pay some heavy surcharges, maybe it makes sense to defer that. So I just did. In this example, you can actually save about $18,000 worth of surcharges over their lifetime by deferring Social Security a couple years, and that's all up front is where that is. So, is it likely? I don't know. But it's certainly worth doing a cost benefit analysis on those surcharges, whether it makes sense and maybe deferring Medicare or not. But anyway, the big impact here, though, and one of the real variables I want to introduce to this is, what if they decide to keep working? Like, raise your hand if you're a small business owner and love what you do, love your clients. Yeah, guilty as charged. Just because I reach a certain age doesn't mean I'm going to stop. I'm probably going to work. I love what I do. I love my advisor clients. And so what if we're in a small business and we decide to keep working? All right. So now we got this $1 million IRA. Instead of using that, that means that money's going to be going to the kids. And I'm just going to live off of my Social Security and the income from the business. Well, how does that impact us? Well, the way that impacts us is that now we got a lot more income in retirement. And the higher the income in retirement, the higher those surcharges we have to pay. And so now you see a couple of things. One, IRMAA jumps off the page, where normally it wasn't anywhere near in the retirement picture, right? It was only an objection really to the conversion. But now you can see, if you're a small business owner and love what you do and you're going to keep working, IRMAA really rears its ugly head in that situation. And so where it was nowhere near, suddenly we're looking at $200,000 to $250,000 in surcharges, because you're making money while collecting and you've elected Medicare. All the way, also, by the way, the taxes are higher too. Why are the taxes higher? Well, taxes are higher because we've got, first off, we're a higher bracket, right? And then when those RMDs kick in, suddenly we're pushing us into a higher tax bracket. Not only just the IRMAA bracket, but we're in a higher tax bracket. It just has a real impact on our tax picture, just because I wanted to do what I love. And so if you have clients that plan to work, even if it's part-time, it still have some impact. Man, some planning really can come into play. All right. So now just one last piece of this. We talked conversion pattern, right? And so you'll notice I originally said we should do a 10-year conversion pattern. I was trying to be extreme just because I think a lot of people think I want to spread this out as much as possible. But when you look here, for one, if you're really concerned about IRMAA, you would probably do a 3-year conversion because you can wrap it up before IRMAA comes into play. Or if you're really just looking at the lowest lifetime total, then that's going to be what, 5 years, right? So anyway, if we're just focused on IRMAA, we can go 3-year conversion. If we're doing the lowest lifetime title, we can go 5-year conversion. So I just go in, rerun the report, and look at this. So if we do a 3-year conversion, just look at the RMD. This is in the scenario where we keep working. My total tax bill through the RMD process on this $1 million IRA is $1.33 million. If we do a Roth conversion, it costs $331,000. That is 7 figures worth of saving. Imagine using that to show your client, I can save you $1 million in taxes over your lifetime by helping you execute a Roth conversion. All right. And that's 3 years. That's not even the optimal, right? If we want to go 5 years, that's how you get the lowest amount of taxes in IRMAA. And in that situation, well into 7 figures in savings. So to me, this is a fantastic topic that you can use. And again, it's meant to be a high level, right? Like we're not diving into the details of planning here. What we're trying to do is show our clients the impact of deferring taxes, really. And so if a majority of our savings are in IRAs and 401ks, and we have this belief that taxes could be higher in the future than they are today, well, then that's a problem. And so we're going to help show and put numbers behind that problem. And then you can also use the multiple scenario approach where you can show how that problem just gets magnified if we have other variables come into play, like if we decide to work. And that was just one example. What if we get some additional growth? Oh my gosh, you do well in your portfolio. Guess what? Tax bill goes up, IRMAA bill goes up. You get penalized for doing well. There's all sorts of variables that can come into play. Has anyone heard the term the widow's penalty? What's the widow's penalty? Right? That's people think about that in their tax situation, right? Where if you are a married filing joint and one member of the couple passes away, you have a surviving spouse, they're now filing single. Well, guess what? That same thing applies to IRMAA, where you might have a couple that is nowhere near the IRMAA radar, but one of them passes away and now they're single. Boom. Now it's a completely different calculation on their surcharges, and it's let's just say it can become a problem, right? And so that's why you're here, to help them be the expert in your area on these issues. And so can they convert? Should they convert? Yes. Can they do it alone? No, they absolutely need a trusted resource like you. And then what should the optimal conversion pattern? Well, let's plug some data in and see, right? So how do you get access to this? It's through Stonewood membership. And it's you can get access to Stonewood through a monthly charge. Some people have what we call an annuity membership, where you're really just looking to do, grow your annuity practice. We have some annuity software, and you talk about that here today. It's called Annuity Alpha. It also comes with our retirement tax bill. It's a lead gen program that it's a button you can put on your website to calculate someone's total taxes. So some people have an annuity membership. Other people come to us because they're looking to grow their life production, and they want to cross that bridge from annuity into life. And so we've got some software and training materials to help people do that. But what most people do is they bundle everything. It's a premium plus bundle. And this new piece of software that I featured today is available in this bundle. And so it's in our premium plus package. And basically you get access to everything, every piece of software that Stonewood has to offer. And that's in that bundle. And you can kick the tires on us, for a couple $100 and see what it looks like. So if you want to learn more about this, what I recommend you doing is just get out the phone. Don't you just love the QR codes? My apologies. You can just go to stonewoodfinancial.com if you like. You can pull up, and kind of learn some stuff and schedule a demo. But the QR codes, as much as older guys like me kind of complain about them, they do make it easier. So if you get out your phone, and that'll take you right to a landing page where you can schedule a demo with our team, and they'll show you the Roth Done Right software in action. And I can tell you already, there is impact to be made here. This is IRMAA is an upcoming topic. And it is when you start to use that term and embrace it and talk to your clients and use IRMAA as an example of an extension of the legislative risk problem that people have, and you are the advisor to help unwind that problem through the conversion process, and we've got all the software now to help you execute that. So I really appreciate to the Stonewood members on this call. I know we got thousands of you across the country. Thank you so much for being a loyal member. If you were a guest today and you're seeing Stonewood for the first time, or if you've been kicking the tires on us a little bit, highly encourage you, get out your phone, scan that QR code, schedule some time with our team, and they can really show you the value of incorporating these tools, these conversations, and the training that we have to offer into your practice, because it will make a difference. So thanks, everyone, and have a great day. Take care.